Hi, I'm Lyn Adams.
I'm Justin Gross.
Hey, we just wanted to take a couple of minutes to talk some more about the defined risk strategy. We are in an environment today that we're hedged out of the market for those folks using the defined risk strategy, and we haven't had that happen in quite some time in the U.S. stocks, and we thought it'd be good to just take a minute and talk a little bit about how it works from this point, okay? So if you review the way the defined risk strategy works, it's designed to keep us out of harm's way when the market gets below the 200-day moving average. We know historically that stocks tend to get in a position where they get sold off and have large losses when the investment community gets scared. So under the 200-day moving average, when we activate the defined risk strategy, we move those stock positions over to short-term bond positions. Now, at this moment, because we are hedged out, it tends to create anxiety, because several things can happen in the short term. So the first thing that could happen is what we call gap out, right? So gap out is essentially what we don't want to happen, but it can happen. Market goes down a lot, and then you have a quick recovery, and the returning entry price is at a higher point than we got out, right? And when we back tested this strategy for 50 years or so, you can see that there's definitely 20 to 30% of the times you'll use the strategy, you'll get gapped out.
Well, it's this would qualify, our tactical defined risk strategy would qualify as a trend following strategy, right? Markets historically move in an up or down sustained direction for some length of time. Very rarely do you get the choppy nature, which that's the market environment that we would be talking about with a gap out, right? So I like to say with this strategy, if we don't really care which way the market goes, up or down, just go hard.
Right.
Give us a sustained trend.
Right.
With the choppy nature of a gap out, that's what could be the downfall of a trend following strategy, is a trendless environment. Mm-hmm. Okay. So that's one option that you experience that volatility up and down.
So imagine if the market went below the 200-day moving average and it went down, let's say 2% below the average, and we moved out. If the next day there was a change in information or a surprise on the upside and the market went up 3%, well, our re-entry trade wouldn't take place until the end of that business day, right? So that 2 or 3% day could be a potential that we say, dang, we missed making 2 or 3%. Right. And that's going to happen sometimes, right? The second thing that can happen, right? All right, you're hedged out, the market's clearly in troubled territory, it's under the 200-day moving average, and things get worse, right? Tomorrow, earnings announcements are poor. Next week, there's a market dislocation. The following week, there's a political problem, and the market precipitates down. Well, it takes some time before the market, 200-day moving average, will come and meet the market as it goes down. Eventually, the market finds a bottom, and the 200-day moving average will find the bottom with it, and at that point, we would re-enter the market. And as Justin just said, you actually want the market to go down a lot when you get hedged out, because the re-entry trade is where you make money, right? Think of it in terms of, if today we had 100 shares of something that was worth $10, and that $10 investment, suddenly 6 months from now we can get it for $8, well, we still got $100. Now we're going to get 12 shares instead of the 10 shares we had when we sold it at $10. Now we re-enter and get it at 8. You'd have 12 shares, give or take. So you want the market to go down an extended amount when you're gapped out or when you're hedged out, so that you can get more shares on the re-entry trade.
Yeah, I mean, with the laws of math, right? As the market goes down, the 200-day moving average, being a trailing function of that, is going to start going down slower, but in the same direction as the market, especially if it's a sustained move to the up or down. Thinking of buying back in, if we do get a large sustained move down, it feels really good,
right,
to be in that short-term bond
you
position
feel like
and
you've
protect.
Won.
Because any investment is just a combination of protect and grow, right? So if we can protect and we're out of the market, we're hedged, I compare it to getting a coupon in the mail, right? You want the 5% off or the 35% off? Well, you want the bigger discount.
Right.
So you want that market to go down so that you can buy back in. And I think that's where this strategy has a leg up on a lot of other ways to do it. Is a lot of people get out We
Right.
got out. Some people could get out, but normally they get out because they're scared. It's an
Mhm.
emotional knee-jerk reaction. And if you get out, you have to ask the question, well, when am I going to get back in?
Right.
And this strategy always has, if we're going to get out, there will be a re-entry.
That's correct.
Okay, and we were in for 2.5 years.
Right.
Since early 2016, we have been in the market,
Mhm.
probably more so in client accounts than normal because of the trend following and the protective nature of this to the downside. So that certainly helped, and it's been a long run above the market. So it's
So from here, just think of it like this. One of three things will happen. We're hedged out. Either the market will bounce really quickly and we'll re-enter when the market goes above the 200-day moving average, and we will have what occurred is called a gap out, and we will have lost 1% or 2%, or possibly a little bit more than that, depending on how fast the market bounces. Or the market will continue to go down, and it'll go down a significant amount. The 200-day moving average will follow it down, and when we re-enter, we'll get a lot more shares than we had several weeks ago, which that's our hope every time we have this process. Or the third thing is the market will move around sideways, and the 200-day moving average will retrench and we'll cross it, and it'll be pretty much a non-event. We'll re-enter about the same price that we got out at. Those are the three mathematical outcomes. Now here's what's interesting. We know one of those three things are going to happen, but we don't know which one. But what we do know, all right, what we know for sure is that when the market is in this position, when we're hedged out, you're not going to lose money in stocks because we don't own any, right? Market goes down another 400 points tomorrow, 1,000 points next week. It doesn't matter. For the people that own the defined risk strategy, there are no stocks involved at this point. So we can rest easy at night that our life savings isn't at jeopardy because the market's going down, down, down. That's not an issue, okay? We do know that over time, we will have some of these occurrences where we get gapped out and we'll lose 1, 2, 3, maybe 4 or 5% occasionally on a gap out. But we also know that over time, on a series of these transactions over years and years and years, we will re-enter and get very good pricing on a lot of other transactions. So the two weigh each other out, and we end up in a good situation for the two together. You have to look at both sides of the trade. The gap out, we consider that the cost to play defense, right? If you lose 2% on a gap out trade, that's the cost. That's what this strategy can cost you. But here's the thing. Most of our clients have their life savings here. They've got not only all that they've worked for all the years that they've worked, but they have their future hopes and dreams tied up in that money as well. So as your accounts get bigger, as it becomes a more serious thing to be an investor, you have to recognize that you have to play defense. To not have a defensive strategy is foolish. So what you have to understand is that when you take the sum of the wins from re-entering at discounts, and you add that to the sum of the losses from when you get gapped out, it's a pretty even trade. But over the long run, when you take everything else, which is being in the market about 80% of the time, you're going to participate 1-to-1 with stocks. And so that's what makes this strategy really, really strong for people that know they need the market to grow their wealth, but they need a defensive strategy.
It's a trade-off. This strategy is not perfect. It will not perform the best at all times, right? Buy and hold sometimes will beat this. But it's a trade-off of really which one do you hate more, and which one maybe is more detrimental to your life savings. Is it getting gapped out and experiencing a couple percent loss, maybe once or twice, and being a little bit different than the market, maybe being down 4 or 5% when the market's up 3 or 4, okay? Or is it the negative 30, 40, 50% drawdown in the market that can mean devastation?
That happens, every 15 years or so we've seen that occur.
Market on average, historically, loses at least 40% once every 10 years.
Right.
We haven't seen it in a long time. That doesn't mean it has to happen now.
Right.
It just means that maybe we're due, historically, statistically speaking.
Right. So that's just a little bit of a rundown on how do we manage our expectations and our feelings and the thoughts that come in our mind when we are hedged out of the market, which doesn't happen very often. As Justin says, we haven't been hedged out in 2 years, and we hedged out this week. Another last thing that we want to point out is that in our strategies, depending on your risk tolerance, a more aggressive person has less of this strategy. A more conservative person has almost all of this strategy, right? So when we say you don't own any stocks, we're talking about those people that have elected to use this strategy for a large part of their portfolio. If you're an aggressive investor with us and you have some of your portfolio in this strategy and other part of your portfolio just in true stocks, then the part that you've held outside the strategy is still invested in the market, and you're going to get more of a true sense of what the market does day to day. So that's all we have for today. We wanted to take this time and just talk a little bit more about the defined risk strategy so that those that are using it can understand it better. Those that have maybe never used it before, just checking it out, it will help you also to understand how it works. And we'll wrap it up with that.